Hi everybody, my name is Ben Madden and this is your premium price property London market update. So what we're going to look at today is the month of June. We're going to do some comparison with the month of May. We're going to look at properties priced above £1 million across London. So that's north, south, east, west and central London. We're going to put on a few different data points. We're going to look at some raw data. I'm going to give you a bit of an overview of what's really happening in the property market. The media, there's no getting away from it, having an absolute field day with everything that's going on. We've got a cost of living crisis. You know, the war in Ukraine rages on. The media are using any opportunity to portray a negative, as we know is almost what they are mandated to do. Clickbait to draw you in and present data in a really unpleasant and unnecessarily negative way. So I'm going to try and cast some light on what we're seeing. I'm going to try and offer you some home truths. There is some risk involved in the future and the property market. Of course there is. We have the threat of a recession, although I'm going to talk about that briefly. We have, I would assume in 2024, we have a general election around the corner. We have interest rates on the up. But actually, when you take everything apart and you remove the anecdotal evidence and you look at the raw data and you consult with appropriate economists that are taking the right view and are not encouraging unnecessary negativity, it's actually an optimistic outlook. And right now, if I was to be anecdotal, being a property professional that has a wide reach across London and actually across the entire UK via my network, I would say that estate agents are reporting that the property market is buoyant. The spring has been a very busy spring market, and as we approach summer, of course, we've just had another interest rate hike, the 13th consecutive interest rate hike, but we're still running below the average for the last 30 years of what interest rates have run at. So let's get into some data. So firstly, when we look at May and June, we saw an uplift of 11% in properties priced above £1 million entering the London market. So as I mentioned earlier, we're talking north, south, east, west, central London, the whole of London, property priced above £1 million. 11% more properties came to market. That's sort of reasonable, actually. May and June, that sort of period of time, you've come out of spring, you've got that summer market where people would like to, I say summer, the early summer market, people want to get themselves sold and under offer before the summer holidays with a view to move in before the new school time starts, or new school year, probably a better way to say that. If we compare that to the sold price points, the sold volume, sold numbers. So this is properties placed under offer. In essence, they haven't exchanged or completed, but their sale has been agreed. In June, the number was down 6%. So we've got 11% more properties entering the market, but the sales rate represents a 6% drop. Now that's not enough detail. I need to give you more of an explanation around this. So because more properties entered the market in June and less sold, we actually need to look at the conversion rate. So what I mean by that is, for every 100 properties that entered the market, how many were sold or placed under offer? That's a much better way of looking at the performance of the market rather than under offer versus new to market, because those two figures, as clearly represented here, can distort what's actually going on. So in May, for every 100 properties that came to the market in London above £1 million, 41 were placed under offer. Now this is sort of runs fairly close to the long run average. In London, it's a strange market. Lots of properties entering the market. They have a punt. The really high priced properties sort of distort the market. Lots of new builds that can also distort the market. In June, for every 100 properties that entered the market, 35 were placed under offer. So that's a 6% shift, which is not insignificant, but it's also not a crazy figure. It's not a crazy place to find ourselves. Another good indicator to look at is what's happening with property pricing, and in particular asking prices. Sale prices, sales achieved, completion prices, they happen further down the line. If a property is sold today, placed under offer, you're looking at 3 to 4 months in the traditional world for that property to reach exchange and then completion. So anything that's happening now, the ripple effect, we don't feel it until further down the line. But we can look at what asking price is doing right now. And so in terms of reductions, in June, reductions were up significantly versus May. But actually, if you look at them as a proportion of properties coming to the market, so again, for every 100 properties that came to the market, in May, 44 reduced their price. In June, for every 100 properties that entered the market, 53 reduced their price. So that is a sizable shift. a 9% uplift in price reductions. But also, it's not uncommon at this time of year. As more properties enter the market in June and people want to get themselves sold in July, naturally, if you came on the market in May and you see more properties coming to the market and you're not under offer, you think about reducing your price. And so this data, to me, represents fairly standard data. From a volume perspective, it might be down, but actually, in terms of proportion, properties coming to the market, properties being sold, and properties reducing their price, nothing here is outrageous. Fairly standard stuff. But so let's move away from the data now and let's talk about what's been going on in the property market, or that's been going on in the economy, maybe impacting the property market. First, I want to talk a little bit about lettings. So there's a lot of talk about the lettings market now being unsustainable. For the last 10 years, there has been huge government intervention in the lettings market, and it's now starting to have an impact. We are seeing across the board that tenants are struggling with the rent increases that are coming in. Rents are up 11% year on year. They show no sign of stopping. We all know, we're all familiar with increased taxation that landlords are now being imposed on landlords. Extra layers of compliance. Some of it, safety regulations, completely agree with. Some of it, box ticking exercises and asking landlords to do the job of what I think should be another agency, perhaps within government or not. And so right now, the general view, the rhetoric in the media is that landlords are going to exit, there's going to be a mass exodus, and the position is actually going to get worse for tenants because there'll be less properties available for them to rent. In a recent survey, though, actually, 41% of landlords are inclined to increase the size of their portfolio. It sort of makes sense, right? Now, I get it that you're, as a landlord, being penalised from a tax perspective, and you see the compliance is a bit of a headache, and we've got the Renters Reform Bill, which has been on the table for a very long time, and there will be implications with the Renters Reform Bill, but if you look into the detail, it's not quite such a scary place. I don't think landlords are going to be punished via the Renters Reform Bill. That's my understanding, but as we know of all these things, they take time to work themselves through, and actually we're looking at 12 to 18 months before we see that impact and be proposed fully within the market or the rental market. So actually, lots of landlords are looking to increase the size of their portfolio. However, smaller landlords are also exiting, and we are seeing anecdotally, via conversation, lettings properties coming to the sales market, which is really interesting because something else that you're likely to have heard or seen or read is how difficult it is for first-time buyers to get on the market right now. Well, in fact, of all the sales, all the housing transactions in the last 12 months, 53% of them were to first-time buyers. That's the highest proportion in the last 10 years. So whilst, yes, can understand that property prices in some areas become unsustainable and difficult for first-time buyers to get on the ladder, actually, when rents are rising 11% year on year, it feels as though first-time buyers are finding a way, because that's a huge jump. More than 50% of the market in the last 12 months has been sales to first-time buyers. On to the next piece of detail. Nationwide have recently reported that property prices in June rose by 0.1%. That's not a major headline, 0.1% in June. They decreased by 0.1% in May, so over a 2-month period we're at net zero. But actually, property prices over the last 12 months are down 3.5%. Now, to take that as a snapshot, yeah, property prices are down. If we go back 12 months, property prices are up in some regions 20% over the last 2 years. So if you look at the last 3 years, property prices are somewhere in the region of 15 to 16% up on their position 3 years ago. So there's a lot to be positive about. Economists expected us to see a 0.3 drop in June, but we saw a 0.1 plus, 0.1 increase in pricing. Now, it's not massive, but it does tell you that the last few years have been very difficult for the intelligence, the economists, the forecasters to get things right, because there's been a lot of getting it wrong. Bank of England told us we'd be in a recession by the end of last year, and that still hasn't arrived. And these people are paid to know this stuff and advise correctly. So I would take everything with a pinch of salt and actually dig down into the detail and see where we are. In my view, property prices are performing extraordinarily well. When a market rises by 20%, what goes up must come down. And for a year on us to be 3.5% down, that is a national average, not just prime property pricing, the whole of the market. I think that's exceptional. If I'd have bought a property 3 years ago, I'd be very happy with the performance. Next on, we're on HMRC transaction volumes in May. Now, the headline is attention grabbing. Transaction volumes in May, so this is completed sales, are down 27% in May versus May 2022. That's 80,000 transactions versus April, the month before, they're down 3%. So no massive shift from month to month, but May 2022 versus May 2023, we are down 27%. Massive headline, but actually when you play it out, when you discuss it in detail, when you work out what that means, that's not a reflection of the housing market as you see it today. So a completion is a property that's been through the conveyancing process, that's been placed under offer, has gone to market. That can be a very extended and protracted process. Now, my best guess, so at the moment in the UK, the average time from a property being placed under offer to being sold and exchanged is about 16 weeks. So that probably means that these May completions were sold in January. It was the January market at which point properties were being placed under offer. So what that really tells us is sales were down approximately 27% in January this year versus January 2022. And if you work in property, that makes complete sense. Because January 2022 was the back end of the crazy frenetic sales market that we all worked in post-COVID. 2 years post-COVID, the market was crazy. The first quarter of 2022, lots and lots of activity. And then, of course, towards the end of 2022, we had the trust quarantine issue that really heavily impacted the market, and Christmas arrived early. And so properties being sold, placed under offer in January this year versus last year, I mean, we're not comparing like for like. The conditions were so different. So yes, there were less transactions in May, but yes, that does relate to market activity 4 or 5 months ago and is not a reflection of market activity today. Properties coming to market, properties being placed under offer. The London prime market in particular has actually seen a 2.5% increase in demand in Q2. So that's very encouraging. Demand being buyers interested in buying in the prime London market. Prime London is 2 million to 10 million pounds. That's very encouraging. That can be actual local national buyers, but of course, with it being London, we're also talking about international buyers. We're talking about cash-rich investors that want to invest in a market that they see as bulletproof, and London does represent that. Whether those of us that live in London appreciate it that much, from an investor from another country, London does represent a bulletproof place to park your investment. Next up, Bank of England base rate rise, the biggie. I think we all saw it coming. Maybe we didn't see it was going to be 0.5%. So 13th consecutive rise. We're now from 4.5% to 5%. As I mentioned earlier, the long rate average is, I think it's 5.6%, something in that region for the last 25 to 30 years. So we are still tracking below the average, but I appreciate we've had 10 years of almost no interest rates. And so for a lot of people, it's difficult to get your head around. For those of a certain age, myself included, would have probably purchased a property on a 5% mortgage or more. And so it feels like a return to normality, arguably, which I know sounds like a strange thing to say. Right now, the impact on the mortgage market, you're looking at somewhere in the region of 6% for a 2-year or a 5-year fixed rate mortgage. We expect some fluctuations. We expect things to change. What we saw at the back end of 22, we saw fluctuations and changes at the start of 2023. And as it happens, the first half of 2023, it started slow, but then spring arrived and the market really reacted in what we would regard as a traditional market norm. The activity levels were where we expected to see them, even though transactions are down year on year. Of course they would be because we've had 2 crazy years. And they're tracking just below the sort of 2017, 2018, 2019 averages. Chancellor Jeremy Hunt, he met with a selection of mortgage lenders and the FCA to discuss support for those concerned about mortgage payments. Perhaps they've got remortgages coming up. So the FCA wanted to point out a few things. They pointed out that less than 0.86%, so less than 1% of all residential mortgage balances were in arrears in Q1. Now, they don't produce the data for Q2 as quickly as maybe we need it. The meeting was only a couple of weeks ago, so Q2 hadn't actually come to an end. But for Q1, we're looking at less than 1% of mortgage balances in arrears, which they point out is a positive place to be. In the last 12 months, all remortgages, on average, the average loan to value ratio on a remortgage was more than 50% equity. So that's huge. on average, over the last 12 months, everyone that's completed a remortgage had 50% equity in their home, which provides a real layer of protection. Whether we want to explore it or not is a different thing, but actually that protection is in place. Beyond that though, beyond looking at the data, there are a host of different concepts put forward, or a whole range of initiatives to help anyone who's worried. The sort of headlines are: you can talk to your lender at any time and express concerns without that having a negative impact on you doing business with them or any sort of credit rating. The ability to switch products. So you can now, I think you have to look at the detail, and it's best to speak with your lender, but I think you can switch products for a period of 6 months. Maybe you want to extend your mortgage length to bring down your monthly repayments. So maybe on a 25-year mortgage, you want to extend to a 30-year mortgage to bring down your monthly payments. Or you could move across from a fixed rate mortgage to a tracker mortgage or a variable mortgage for a period of 6 months and then go back. You can also explore taking on a new mortgage earlier, before the end of your current mortgage position, I think again by 6 months. But what's most important, one other major one, that repossessions will not begin. You cannot have your home repossessed for at least 12 months after your first missed payment. Now, that sounds really threatening. It sounds quite ominous. There's a reason for the dialogue. There's a reason they're presenting this information. It's to help people, but it's also to scare people perhaps into spending less, because inflation right now is very, very sticky and we're struggling to get it down. The reason it's not coming down, of course, someone said to me today that food inflation is insane, and it is. It's right. It's a difficult thing to deal with, but we could all do with spending a little bit less right now, actually, to try and drive down inflation. Other information that I think is really, really relevant and pertinent. Firstly, with regards to financing, the percentage of pay people currently spend on their home financing, so on their mortgage, on average is sitting at 33%. Now that is 1% above the 30-year average. So I think the media paint a picture that people can't afford where they are. And certainly things aren't going to be rainbows and unicorns for the next few months. For people coming out of their fixed rate mortgage product, they need to explore different things. But we're sitting at around about the same ratio as we have been for the last 30 years in terms of our inbound funds committed to our mortgage payments. The other thing to consider is that average earnings are up somewhere between 7 and 7.5%. So people are making more, and people with a mortgage have been stress tested to ensure this sort of thing doesn't cause issues. I'm not saying it's that, of course it's not that simple. Everyone's lives are very different to when they first took that mortgage product. Maybe they have more children, maybe they have different work commitments or life commitments, whatever it might be. And so there is going to be a requirement for people to shift their thinking, and there will be some people that end up moving because they aren't comfortable with what they will need to pay as their mortgage product pricing changes. But there will be others that will tighten the belt. They maybe won't go on the holidays they would have before, they maybe won't upgrade their car, and they'll find a way. It's estimated that in the next 12 months, 1.2 million households will need to remortgage. But as I said, it's also looking like, if you come away from the media and the clickbait scare factor that's being presented, it's looking like a lot of those people are going to jump from anywhere from 1.5 to maybe 6.5. And based on what happened in the lockdowns, there's a lot of data to support that people are holding funds, is maybe not an appropriate way to say it, but there's savings, and nobody wants to eat into their savings to make a mortgage payment. But from a short-term perspective, or maybe a mid-term perspective is a better way to look at it, sometimes needs must. And if you were to take a product for the next 2 years and subsidise the payment of that mortgage with savings or whatever it might be, in 2 years you can move off that rate. I was part of something yesterday, and the goal is to bring inflation down. What looks realistic is that we could be at 5% by the end of this year, and in 2024 hopefully be at 4%. The major issue we've got really is incompetence at government. The Bank of England have clearly only got one policy when it comes to resolving inflation. That's not really working. It's punishing maybe some of the wrong people. And then we've got the issue with media coverage of what's going on. And the media's coverage is removing certainty and creating fear. And I don't think that's appropriate. Hopefully what I've discussed today gives you a good indication that the property market, at least, is performing robustly. when we look at how the property market is performing now versus the last financial crisis, we're not comparing like for like in any way whatsoever. In 2007, 16.5% of people had less than 10% equity in their property. Now, 1 in 25 people have less than 10% equity. So there is equity, there is protection. When you look at listings, so the reason we had property prices drop in 2008, of course, financial crisis, banks couldn't lend, that disappeared from the market. People couldn't remortgage, the market was flooded with properties because people couldn't afford those properties. We are not in a position where that's happening right now. We are not seeing lots of properties flooded to the market. In fact, in some markets, we're seeing less properties entering the market. Nationwide, we're currently seeing 32,000 on average properties enter the entire property market. 22,000 of which are selling every week, and 7,000 to 8,000 are being withdrawn. So there's a swing of maybe 3,000 properties that need a price reduction, may sell, may be withdrawn. In London, in 2008, when we had the property market crash, in a period of 6 to 7 months, we went from 53,000 properties on the market to 99,000, which is a huge jump. And it gives you an idea of what we'd need to experience for those that sort of reaction to impact the property market. This is what would need to happen for the property market to see significant reduction in property price points and significant reduction in transactions, neither of which we're experiencing right now. There is a shift in pricing and a realigning of the market, if you like, and property transactions will be down in 2023. There's no doubt about it. But 2021 and 2022 were exceptional years, and we'll be down on probably 2019, 2018, marginally, but not significantly. So look, I hope this has been a useful and a helpful update on what the market's doing, and I look forward to seeing you guys soon. If you've enjoyed it, give us a like, hit subscribe. Cheers, guys.